What's up? What's up?
This involves big money, John.
Yeah?
Did you ever hear of Ichabod Bonanza Mining?
No.
This stock sells on the Brazilian exchange, and my broker just gave me a real hot tip on it.
Ichabod Bonanza Mining? Sounds like a fly-by-night outfit to me.
Fly-by-night? This is a gilt-edged blue-chip #1 security.
Well, how much is it selling for?
10 cents a share. My broker says it's bound to go up to $5, $10, $15. They made a big strike on some space-age metal, and the news isn't out yet. Oh, boy, I wish I had thousands to put in it.
No kidding.
I'm buying 1,000 shares. Now, that's $100. You want in?
That sure doesn't sound like much of a risk.
It's the chance of a lifetime.
What's the headline here?
Stock market's rigged. The United States stock market, the most iconic market in global capitalism, is rigged.
By whom?
By a combination of the stock exchanges, the big Wall Street banks, and high-frequency traders.
The stock market is rigged.
If it wasn't complicated, it wouldn't be allowed to happen. The complexity disguises what is happening. If it's so complicated you can't understand it, then you can't question.
And this is all being done by computers?
All being done by computers. It's too fast to be done by humans. Humans have been completely removed from the marketplace.
Fast is the operative word. Machines with secret programs are now trading stocks in tiny fractions of a second, way too fast to be seen or recorded on a stock ticker or computer screen, faster than the market itself. High-frequency traders, big Wall Street firms, and stock exchanges have spent billions to gain an advantage of a millisecond for themselves and their customers, just to get a peek at stock market prices and orders, a flash before everyone else, along with the opportunity to act on it.
The insiders are able to move faster than you. They're able to see your order and play it against other orders in ways you don't understand. They're able to front-run your order.
What do you mean front-run?
It means they're able to identify your desire to buy shares in Microsoft and buy them in front of you and sell them back to you at a higher price. It all happens in infinitesimally small periods of time. Their speed advantage that the faster traders have is milliseconds, sometimes fractions of milliseconds. But it's enough for them to identify what you're going to do and do it before you do it at your expense.
So it drives the price up.
So it drives the price up, and in turn, you pay a higher price.
Ever feel like the stock market is a game where only the big players win? If so, you're not the only one thinking that. Many believe that the stock market is set up in a way that gives the advantage to the big guys and leaves the smaller, everyday investors picking up the crumbs. Today, we're going to break down why many folks feel this way. We'll discuss how certain systems, like super-fast computer trading, can give an edge to big companies. We'll also dive into why it seems like the rich get richer while the little guys struggle to catch a break. It's important to know what we're up against if we decide to dive into the world of stocks. The goal here isn't to scare you away, but to arm you with knowledge, because knowing the lay of the land and the challenges ahead is half the battle. Hello, everyone. I'm Todd from Infinite Growth TV, where we delve deep into the 5 social determinants of wealth. Our goal is to arm you with practical information you can apply directly to your life, helping you grow infinitely in your life's journey. If our content speaks to you, please give us a thumbs up and subscribe to the channel. And don't forget to hit the notification bell so you stay updated with our latest insights. Now, let's dive right back into our topic. The stock market has often been compared to a playground, but the reality is that not everyone playing in this so-called playground starts on equal footing. Larger institutions, hedge funds, and high net worth individuals are the giants in this field. They possess the resources, both monetary and informational, to make the stock market work for them in ways that smaller investors simply cannot emulate. Let's begin with the most obvious advantage, the monetary leverage that larger players have. The sheer size of their investments can not only move markets, but can also create opportunities that simply don't exist for smaller investors. For instance, a hedge fund making a multi-million-dollar bet on a stock could trigger automatic buying from index funds, thereby driving up the stock's price and ensuring a quick profit for itself. This kind of market movement clout is simply unavailable to smaller investors who must react to market movements rather than initiate them. The advantages don't stop at market moving investments. Larger investors often have privileged access to new stock offerings long before these stocks are made available to the general public. Imagine being offered a VIP ticket to a concert before regular tickets go on sale. By the time the average Joe can buy these stocks, their price often has already been driven up by early investors from larger players, essentially stacking the deck against smaller investors from the outset. Large players often have negotiation leverage as well. When you're buying millions of shares, you can negotiate the price per share, the fees, and other transaction costs. This reduces the overall cost of the investment, thereby increasing the profit margin. Smaller investors, on the other hand, have to accept standard rates, which eats into their already smaller potential profit. The ability to spread risk is another often overlooked advantage. Large investors can afford to take calculated risks because they can spread their investments over a vast array of stocks, bonds, commodities, and even currencies. They have the capital to absorb shocks from one sector by gaining in another. Smaller investors often don't have this luxury. For them, diversification can mean choosing between different types of stocks, but they can rarely spread their risks across different asset classes effectively. The edge isn't just financial, it's informational as well. These big players have entire teams dedicated to research. They have advanced algorithms that can read and interpret news in real time, sometimes written by other algorithms designed to produce news summaries faster than any human journalist could. They can employ satellite imagery to count the number of cars in a retail store's parking lot or scrape social media data to gauge consumer sentiment about a product. The depths of their information gathering capabilities are staggering. Meanwhile, the average investor may rely on popular news outlets, which only report information long after these big players have acted upon it. Time is money, and nowhere is this truer than in the stock market. Large investors leverage high-speed trading algorithms that can execute thousands of orders in the blink of an eye, capitalizing on price differences that exist for only fractions of a second. This kind of trading might seem far removed from the strategies of long-term investors, but it has a significant impact on market conditions, often creating volatility that can wipe out smaller players. Moreover, these larger entities often have a social and professional network that gives them yet another edge, whether it's advanced notice of a regulatory change or the inside scoop on an emerging technology. Information travels faster within these networks, giving big players another layer of advantage. Lastly, let's not overlook the influence these large entities can wield on market regulations. Through lobbying and other means, these large players can sometimes bend the rules of the market in their favor, creating conditions that most small investors can't even begin to compete with. So when we talk about big players having an advantage in the stock market, it's not just a single factor, but a multitude of financial, informational, and social levers that they can pull to their benefit. In such a landscape, the smaller investor should not just be aware of these disadvantages, but should actively seek strategies to mitigate them. High-frequency trading is a term that's become synonymous with the evolving complexities of modern stock markets. At its core, high-frequency trading involves executing large numbers of trades at extremely high speeds, often in fractions of a second. These aren't decisions made by human traders over coffee. They're made by powerful computers and algorithms scanning the market for minute inefficiencies to exploit. Imagine the stock market as a busy marketplace where every millisecond thousands of people shouting their buying and selling prices. Now imagine a superhuman individual able to hear a price, decide on its value, and shout out a counteroffer, all in a split second. That's high-frequency trading. They analyzed vast amounts of market data, identifying patterns and making predictions faster than the human mind can comprehend. This speed grants high-frequency traders significant advantages. For instance, if a piece of breaking news suggests a company's stock might rise, high-frequency traders can buy it up before most retail investors even hear about the news. By the time regular traders act, prices have already adjusted, and the opportunity is gone. This speed advantage can sometimes feel like competing in a race where your opponent starts several meters ahead. Another controversial aspect of high-frequency trading is its contribution to market volatility. Remember the flash crash of 2010? The Dow Jones plunged almost 1,000 points within minutes, largely due to high-frequency trading. While they add liquidity to the markets, they can also cause rapid price swings, which can be detrimental to retail investors who can't adjust their positions quickly enough. Moreover, there's an arms race in the high-frequency trading world. Firms spend fortunes to upgrade their infrastructure, striving to be even a millisecond faster. This has led to an environment where the player with the most advanced technology often comes out on top, leaving everyone else behind. From the perspective of the small individual trader, HFTs can seem like insurmountable giants. They represent a tier of market participation that's simply out of reach for most. And while regulators have tried to level the playing field, it's undeniably that HFTs have changed the stock market game in ways that often don't favor the little guy. The old adage, knowledge is power, has never been truer than in the stock market. Access to timely and accurate information can mean the difference between a profitable trade and a losing one. And unfortunately, not everyone has equal access to this crucial asset. Big institutional players with deep pockets invest heavily in research and data analysis. They employ teams of analysts who scrutinize every detail from quarterly earnings report to global geopolitical shifts. This comprehensive research is often beyond the reach of the average individual investor. Beyond just raw data, large players have access to real-time analytical tools and services. These tools can provide instant insights into market movements, often predicting trends before they happen. Such services are expensive and are mostly out of reach for retail investors who might rely on delayed or summarized versions. Another less discussed advantage is the networks that these large players have. In the world of finance and business, relationships matter. Being in the right circles can mean getting early tips about mergers, acquisitions, or other market-moving events. By the time such news reaches the general public, the big players have acted upon it and adjusted their strategies. For the retail investor, this delay can be costly. Acting on old information means they're always a step behind, entering or exiting positions at less than optimal times. Over the long term, this informational disadvantage can result in significantly lower returns. While there are regulations in place, like the Regulation Fair Disclosure, Reg FD, to ensure that all investors have access to material information at the same time, there are still many legal ways in which institutional players can get a jump on their smaller counterparts. In today's market, computers, not humans, dominate trading. The days of stock market floors buzzing with traders shouting buy and sell orders are fading. Instead, silent data centers filled with servers running complex algorithms and making decisions at lightning speeds. Algorithmic trading involves using computers programmed to follow a defined set of instructions for placing a trade. These instructions or algorithms are designed to perform a strategy that maximizes profits at speeds and frequencies that a human trader can't achieve. These algorithms can analyze market data, spot trends, and execute trades in milliseconds. Much like high-frequency trading, the primary advantage of algorithmic trading is speed. Computers can process vast amounts of information and react to market changes far quicker than humans. For retail investors, trying to compete against these algorithms can feel like trying to outrun a sports car on foot. Beyond just speed, algorithmic trading offers depth. These programs can analyze multiple market conditions across various indices and sectors simultaneously. They can track everything from macroeconomic indicators to the tone and sentiment of news articles. While some retail investors might dabble in basic algorithm strategies, they often lack the resources for the deep, multifaceted analysis big firms achieve. Furthermore, large institutions can afford to refine and adapt their algorithms constantly, ensuring they remain at the cutting edge. For many small investors, algorithmic trading represents an impersonal market where decisions are made based on cold calculations rather than human judgment. The worry is that as algorithms become more prevalent, the stock market becomes less about company fundamentals and more about exploiting tiny inefficiencies at high speeds. Brokerage firms are intermediaries that execute buy and sell orders on behalf of investors. On the surface, they offer a valuable service, providing investors access to stock exchanges. However, not all brokerages are created equal, and some of their practices may not always align with the best interests of their retail investors. One contentious practice is payment for order flow. Here, brokerages are compensated for directing their orders to particular parties, often large market-making firms. While brokerage firms claim this doesn't affect the execution price, critics argue it creates a conflict of interest. The broker's incentive might be to direct orders where they'll earn the most, rather than where the investors get the best deal. Retail investors need to be wary of fees. Some brokerages charge a variety of fees, from commission costs to account maintenance charges. Over time, these can eat significantly into an investor's return. Moreover, not all of these fees are transparent, leading many small investors to pay more than they realize. When companies go public, their shares are often in high demand. Large clients of brokerage firms usually get the first dibs on these, leaving fewer shares for retail investors. By the time these smaller players can buy, the price has often surged beyond the offering price. At the end of the day, brokerages are businesses. Their goal is to maximize profits. And in the power dynamic between individual retail investors and big brokerages, the latter often have the upper hand. This can result in practices that prioritize the brokerage's bottom line over the retail investor's best interest. The stock market is a vast ocean, but few entities make waves as significant as the world's leading banks. Their influence stems from the sheer volume of assets they manage and the myriad of roles they play in the financial sector, from underwriting new stock issues to providing research and analysis. One contentious point is that the dual roles banks often play. A bank might underwrite an initial public offering, or IPO, for a company, meaning they help the company sell its stock to the public. Simultaneously, their research department might release reports or ratings on the same company. This possesses a potential conflict of interest. Can a bank genuinely give unbiased advice on a company it has a financial stake in? Over the years, there's been instances where large banks were accused of manipulating market prices. By moving vast sums of money quickly, they can create artificial buying or selling pressures. For the retail investors unaware of these large-scale movements, they risk buying at inflated prices or selling at depressed ones. The ability of large banks to lend money adds another dimension to their influence. By choosing which sectors or companies to lend to, they can indirectly shape market trends. Companies favored with easier access to loans might perform better, giving them a leg up over competitors. Given their central role in many market operations, large banks often have access to information before it becomes public knowledge. And while strict regulations try to prevent misuse of this information, there have been instances of insider trading linked to bank employees. Financial markets don't operate in a vacuum. They're overseen by regulatory bodies designed to ensure fairness, transparency, and stability. In the U.S., for instance, the Security Exchange Commission, SEC, plays this role. However, the effectiveness and reach of such regulators have been a point of debate. A common criticism is the revolving door phenomenon, where professionals switch roles between regulatory agencies and the industries they regulate. This interchange raises concerns about impartiality. If a regulator knows they might later seek employment in the private sector, will they be less stringent in their oversight? Another point of contention is access to government data. While critical financial data is supposed to be released to everyone simultaneously, there have been claims that some entities get a sneak peek. This head start, even if just by a few seconds, can be immensely lucrative in trading. Financial institutions invest significantly in lobbying efforts to shape regulatory policies. Their influence often dwarfs that of groups representing retail investors. This can lead to regulations skewed in favor of big market players. Lastly, while regulations exist, their enforcement can sometimes be inconsistent. Big players might face slap on the wrist fines for infractions that would bankrupt smaller entities. For retail investors, this creates a perception of a rigged game where big players can flout rules with minimal consequences. In financial markets, concentration refers to the significant control or ownership of trading volumes by a small number of entities. When a few major players dominate, it can distort natural market movements, potentially sidelining retail investors. Hedge funds, with their vast resources and aggressive trading strategies, can significantly influence stock prices. They often engage in coordinated trading strategies that can artificially inflate or deflate prices, leaving retail investors chasing shadows. Mutual funds, especially those tracking market indices, hold significant portions of many companies. Their trading activities, driven by the need to balance portfolios or respond to redemptions, can result in vast market movements, often unrelated to underlying company performances. Pension funds, managing the retirement savings of millions, have significant market influence. Their trades, often large and influential, can shift market sentiments, leaving smaller investors to adapt or be left behind. To put things in perspective, according to some estimates, the top 10% of the wealthiest households own as much as 84% of all stocks. This concentration means that decisions made by this small group can have outsized effect on market directions, often at the expense of smaller investors. In an ideal world, every investor would have access to all pertinent information before making investment decisions. However, the reality is starkly different. Information asymmetry, where one party has more or better information than the other, is a significant concern in financial markets. Insider trading occurs when individuals with non-public material information about a company's stock use that information to trade. This gives them an unfair advantage over other investors who don't have access to that information. Not all insider trading is illegal. Company insiders, such as officers, directors, or employees, can buy and sell stock in their own companies. But the rules are strict. They must report their trades to the SEC, and they can't act on non-public information. Despite regulatory efforts, illegal insider trading remains a concern. Detecting it requires tracing back unusual trading activities to non-public information, a task easier said than done. For retail investors, the spectacle of insiders acting on privileged information adds to the feeling of an uneven playing field. Over the years, several high-profile insider trading cases have made headlines. These incidents, often involving top executives or famous personalities, serve as stark reminders of the information imbalances inherent in the system. Stories drive the stock market, whether it's tales of booming tech startups or gloomy reports of economic downturns. Narratives shape investor sentiment, and these narratives are often controlled or heavily influenced by financial media. Turn on any financial news channel, and you'll be greeted by a slew of market pundits, each with their own predictions and analysis. However, these predictions, often conflicting, can confuse more than clarify. The retail investor trying to sift through the noise can easily be led astray. Sensational stories, even if short on substance, often get more airtime than nuanced, in-depth analysis. For the everyday investor, this can result in a skewed perception of market realities. Media entities aren't always neutral. They have owners, advertisers, and other stakeholders. These affiliations at times can influence the content they broadcast. An endorsement or criticism of a particular stock or sector might be driven by factors other than pure market analysis. In this sea of narratives, retail investors face the daunting challenge of distinguishing fact from fiction and genuine analysis from mere opinion. Often, they're reacting to news rather than anticipating it, always a step behind those who created or have early access to these narratives. In the vast financial landscape, the stock market stands as a monumental arena where fortunes are made and dreams are often dashed. For the retail or small investor, the challenges are many, and the playing field often appears skewed against them. We have covered a lot in this video. What are your thoughts? Please place your comments below. I would love to read your views. Also, please like and subscribe if you found this information insightful and useful. The more we value things outside our control, the less control we have. In the realm of stock markets, this ancient wisdom reminds us to discern what's within our grasp and what isn't, and to act accordingly. If you found value in today's discussion and insights, please remember to like and subscribe to our channel for more enlightening content. Your support helps us continue these important conversations.